Hi, I'm Andy, and welcome back to the AI Investing Challenge, where I let artificial intelligence pick stocks, and I just sit here hoping it doesn't accidentally recreate the 2008 financial crisis. Every Friday after the market closes, I invest £10 into a UK-listed stock chosen entirely by AI. No vetoes. No I'm not sure about that one. No human meddling. Just pure machine-driven stock picking. Today, I'll show you the stock the AI chose for this week. And at the end, I'll reveal 3 things. The current value of this week's investment, the total value of the challenge so far, and the next stock the AI has already lined up. So, what did the AI pick this week? Well, let's just say it went for a company that loves numbers so much it practically tucks spreadsheets into bed at night. Please be aware I am not a financial advisor, and nothing in this video should be taken as financial or investment advice. Everyone's situation is different, so please do your own due diligence and consult with a certified professional before making decisions. Investing always carries risk. Your money is never guaranteed, and you could lose some or all of your investment. To keep things fair, consistent, and mildly chaotic, the AI follows the same rules every week. It must choose a UK-listed company with solid financials, medium-term growth potential, no glaring red flags, and it can't pick the same stock again for 6 to 8 weeks. This stops it from spamming the same favorite stock over and over, and keeps the challenge feeling like a proper investing experiment rather than the AI shouting Rolls-Royce until I give in. This week's pick is Sage Group plc, ticker SGE. Sage is one of the UK's heavyweight software companies, the kind that quietly powers millions of small and medium-sized businesses behind the scenes. They build accounting tools, payroll systems, and business management software that helps companies stay organized, compliant, and, hopefully, profitable. Sage matters because it sits right in the middle of the SME economy. When businesses need to pay staff, file taxes, or keep the books tidy, Sage is often the digital glue holding everything together. The AI went for Sage because it's a steady, reliable operator with a big base of recurring subscription revenue. It's shifting more of its business into cloud software, which tends to be higher margin, stickier, and more predictable. And predictable is basically the AI's love language. The sector is resilient, the customer base is loyal, and Sage has been quietly improving its financial strength year after year. Alright, let's bring up the key numbers the AI looked at for Sage. Here they are on screen now. We've got a trailing PE of 24.50. And a forward PE sitting around 18.12 to 18.10. The PEG ratio comes in between 1.08 and 1.26. Revenue growth year-on-year is plus 9.7%, and earnings per share are growing at plus 8.9%. Next up, Sage net debt to EBITDA is 2.29 times. Cash conversion is strong at around 85%. And finally, Sage's latest free cash flow figure comes in at £632 million. These are the raw stats the AI used before digging deeper into the analysis. Now that we've seen the raw numbers, let's dig a little deeper into what they actually mean. This is where the stats stop being just numbers on a screen and start telling us a story about Sage as a business. PE ratio. The PE ratio is the price tag investors put on each pound of Sage's earnings. Think of it like buying a calculator. If it costs £24 for every pound of usefulness, you want to know it's doing some serious number crunching. A mid-range PE like Sage suggests stability, not bargain basement cheap, but not wildly overpriced either. It's the maths class equivalent of sitting comfortably in the middle row. Forward PE. The forward PE looks ahead using expected future earnings. It's like checking next year's timetable to see if things get easier. A lower forward PE compared to the current one hints that earnings are expected to grow, almost like the denominator in a fraction getting bigger, shrinking the whole ratio. That's usually a sign of improving profitability. PEG ratio. The PEG ratio is literally PE divided by growth. A neat little fraction that tells you whether the price matches the pace of growth. A PEG close to 1 is like balancing an equation perfectly. If it were way above 1, you'd be paying premium prices for basic arithmetic. Sage PEG sits in that sweet spot where the math checks out. Revenue growth. Revenue growth shows how fast Sage is expanding the top line. Imagine drawing a line graph. If the slope is positive, the business is moving in the right direction. Sage growth comes from cloud subscriptions, recurring sequences that repeat and compound over time. Investors love patterns like that. EPS trend. EPS growth tells us how fast profits per share are rising. It's the business equivalent of improving your test scores every term. Steady EPS growth usually means better margins or efficient scaling. It's like simplifying a messy algebra expression into something cleaner. Net debt to EBITDA. This ratio shows how comfortably Sage can handle its debt. Imagine it as a division problem. Debt on top, earnings on the bottom. The smaller the result, the easier life is. A ratio around 2 means Sage could theoretically pay off its debt in about 2 years of earnings, a sign of financial stability. Cash conversion. Cash conversion tells us how good Sage is at turning accounting profits into actual cash. If EBITDA is the theoretical maths answer, cash conversion is the real-world check to see if the answer works. At around 85%, Sage is basically saying, yes, we really do collect the money. It's like solving a problem and checking it with a calculator and getting the same result. Free cash flow. Free cash flow is the money left over after running the business and investing in essentials. It's the final number at the bottom of the page, the one that tells you how much flexibility the company has. Strong free cash flow means Sage can invest, acquire, pay dividends, or build a buffer. It's the mass equivalent of finishing the exam early with marks to spare. Now, when the AI looks at Sage, it starts by zooming in on free cash flow. Think of this as the real pile of cash left over after the business has paid its bills and invested in keeping things running. The AI works through the numbers and lands on £632.25 million. In simple terms, that's a serious amount of spare cash the company can use for dividends, reducing debt, or reinvesting for future growth. Then the AI shifts to the next question. How good is the company at turning its profits into actual cash? To figure that out, it checks the cash conversion ratio. At 85%, the AI sees a business that's converting most of its reported profits into real money in the bank. That tells the AI the company is managing its working capital well and keeping tight control over the financial plumbing behind the scenes. When you put these two pieces together, the AI's logic becomes clear. Strong free cash flow shows the business generates plenty of cash. High cash conversion shows it actually keeps hold of that cash. So the AI concludes that this is a company with healthy profits and reliable liquidity, the kind of combination investors pay close attention to. So, how many shares did my £10 buy? At the time of purchase, the share price was £9.87.2. That means I bought just over 1 share. And right now, at the time of recording, the value of that investment is £10.57. That is a 62p gain for this stock this week on its own. Here's the updated AI challenge pie, showing how the fund is split and how the challenge is performing so far. As always, investing carries risk. Prices can go up or down. The total value of the challenge is currently £144.28, which means an overall gain of £4.28 since we started. That is a massive jump from last week. But remember, this challenge is about the medium term, not quick wins. This week in the challenge, I continue tracking the performance of the selected stocks. The market showed a relatively positive week this week, with most positions gaining strength while a few dipped slightly. The portfolio is continuing to build real-world data. There were no dividends though. The best performing stock this week was Sunbelt Rentals again, showing steady upward movement and solid operational momentum. The worst performing stock this week was AstraZeneca, which experienced a small pullback. To keep things diversified, the AI won't pick Sage, Smith Nephew, Experian, AstraZeneca, Halma, CURY, Sunbelt Rentals, or Computacenter again for at least 6 to 8 weeks. And now, the moment you've been waiting for. The AI has already chosen the stock for next week. And that stock is RelX, our third repeater to date. We'll break that company down in the next video. If you want to follow this challenge week by week, make sure to like this video and subscribe. It really does help with the algorithm. Also, feel free to leave any comments. I'd love to know your thoughts and what you'd like to see in the future. If you want to see any of my other videos, check out the ones to the right of this video now. The bottom one is the one YouTube thinks you may like to watch next. See you next time.